By this Saturday, the United States government may partially shut down, not because it ran out of money, but because it ran out of political consensus. Behind closed doors in Washington, risk models are now pricing an approximately 80% probability that Congress fails to pass a funding agreement in time. Markets are watching, allies are watching, rivals are watching. A U.S. government shutdown is not just a domestic inconvenience, it is a stress test of American credibility at a moment when the dollar underpins global trade, U.S. debt anchors world markets, and American power remains the central pillar of the post-World War II financial order. This is not about parks closing or delayed paychecks. This is about money, leverage, and the perception of control. To understand why this matters, you have to understand what a U.S. government shutdown really is. The U.S. government does not shut down because it is insolvent. It shuts down because Congress, divided by ideology, factional power struggles, and electoral incentives, fails to authorize spending that has already been politically agreed upon in principle. This is a uniquely American vulnerability. Since 1976, the U.S. has experienced more than 20 shutdowns. Most were short, a few were long. All of them sent the same signal. The world's most powerful state can still be paralyzed by internal politics. What makes this moment different is timing. The U.S. is running record deficits. Interest payments on U.S. debt now rival defense spending. The Federal Reserve is attempting a delicate balancing act between inflation control and financial stability. Global conflicts, from Ukraine to the Middle East, depend on U.S. fiscal and military coordination. A shutdown now would not occur in isolation. It would land inside an already fragile global system. At the center is a fractured Congress, where governing coalitions are weaker than ideological factions. Budget negotiations are no longer about spending levels alone, they are tools of political leverage. Some lawmakers see shutdown risk as acceptable collateral damage, others see it as electoral suicide. The result is paralysis. The executive branch has limited tools in a shutdown scenario. Agencies can prioritize essential functions, but strategic initiatives, from technology investment to foreign aid, freeze. Power shifts from long-term planning to crisis management. The Federal Reserve is officially independent, but not immune. A shutdown disrupts economic data collection, employment, inflation, GDP, forcing the Fed to make policy decisions with partial blindness. Markets hate uncertainty. Central banks hate data gaps. Beyond Washington, global stakeholders are closely exposed. Foreign governments holding U.S. treasuries, multinational corporations dependent on U.S. regulatory approvals, defense partners relying on U.S. funding pipelines, and strategic rivals quietly measuring American dysfunction. In geopolitics, perception is power. A shutdown weakens the perception of U.S. coordination at a critical moment. Short-term shutdowns rarely crash markets, but they reprice risk. Treasury bill yields can spike around maturity dates. Credit default swaps on U.S. debt quietly widen. The dollar may strengthen paradoxically at first, then weaken as confidence erodes. The danger is not collapse. The danger is normalization, when dysfunction becomes expected. The U.S. dollar remains dominant, not because America is perfect, but because it has been predictable. Shutdowns chip away at that predictability. For countries already exploring alternatives, BRICS trade mechanisms, bilateral currency agreements, gold accumulation, each shutdown becomes another data point in a long-term de-dollarization thesis. Funding delays ripple outward. Defense contractors slow production. Cybersecurity and AI governance initiatives stall. Intelligence agencies operate under constrained authorities. In an era where war is increasingly digital, bureaucratic friction becomes a strategic weakness. Ordinary people feel this immediately. Federal workers miss paychecks. Small businesses dependent on government contracts face liquidity stress. Mortgage approvals, visas, and regulatory decisions slow. This is how macro dysfunction becomes micro pain. If the shutdown occurs, expect a temporary hit to economic confidence, political escalation rather than resolution, and markets that are initially calm but increasingly sensitive to headlines. Historically, shutdowns end not through consensus, but exhaustion. Repeated shutdown threats accelerate structural shifts. Investors demand higher risk premiums. Allies hedge dependence on U.S. systems. Domestic trust in institutions continues to erode. The U.S. does not lose power overnight. It loses it gradually, through friction. The real risk is precedent. If shutdowns become routine, they transform from crisis events into background noise until one coincides with a major external shock, a financial crisis, a military escalation, or a systemic banking failure. History shows that empires rarely fall from a single blow. They weaken through internal incoherence. An 80% chance of a U.S. government shutdown is not just a budgeting problem, it is a signal about governance, credibility, and the sustainability of global leadership. The world is not asking whether the U.S. can pay its bills, it is asking whether the U.S. can still govern itself under pressure. And in geopolitics, that question matters more than any headline number.